네, 앞서 박서연 캐스터와 함께 여러 가지 뉴욕 증시가 휴장인 상황에서 쏟아져 나왔던 외신들까지 짚어봤습니다. 상하이 이슈 그리고 원자재, 비트코인에 대한 이야기까지 전달을 좀 해드렸는데요. 뉴욕 증시는 움직임이 없었지만 유럽 증시 같은 경우 미로 짐작해 보건대 살펴보면 대부분의 지수가 상승한 것을 확인할 수 있었습니다. 이렇게 글로벌 증시가 그나마 좀 숨통을 트이나 하고 기대감을 가진 투자자분들이 많으실 텐데요. 월가 트레이더 버니의 미국 주식 시간으로 넘어온 만큼 뉴욕 증시 지금 현재 상황을 진단해 보고자 합니다. 버니 씨께서는 불안한 장세가 계속해서 지속됐던 5월 동안 그리고 상반기 동안의 시장 흐름을 자세하게 짚어주실 텐데 시장과 그리고 개별 종목 그리고 종목이 속해 있는 섹터분들의 움직임을 분석을 해드린다고 합니다. 오늘도 준비해 주신 내용 지금 바로 만나보시죠.
Let's get a little more specific and detailed now and identify and analyze sectors of the market and individual stocks and how they've performed and what we can say about them. So what we know so far is that we have a rising rate environment, and that has basically been one of the leading components to force our market a little bit lower in the short term meaning 3 to 6 months time frame, 3 to 9 months time frame. So far, we're into about month 4 of this whole thing. If we want to look at a lot of the people that participate in the markets, a lot of people participate in the markets through ETFs, whether they're buying bond fund ETFs, money market fund ETFs, stock fund ETFs. They get some diversification that they're happy with. Their volatility is dampened. They won't see stocks that go from, say, like Shopify did when it went from $500 in March of this year up to $750. Okay, so we basically rallied 50% in a 3-week window, and then unfortunately came back down to $488. So there are some of those stocks that you'll never see that kind of volatility in an ETF. But let's look at the ETFs and what's gone on so far. What we know is that we're in a rising rate environment. And so within that rising rate environment, short rates are going higher, but they're going higher from very, very low levels, okay? And long rates are going higher. They're still going higher from very low levels also. But what we've seen in this chart right here is the blue line is the bond funds, the purple line is the money market funds, and the orange line are the equity funds. So what we've seen so far, when we go back and look at COVID, okay, because that's a great example. When we go back and look at COVID, the market went down a ton. People got freaked out, and they went all into cash. They sold their bonds, they sold their equities, and they went into cash. Those are great identifications of market bottoms. No one knew what was going to go on. They're like, get me out at any price, get me into cash at any price, and lo and behold, the market rallied just tremendous amount off of that low. What we've seen this time is the blue lines going down, the bond funds going down, but the money market funds are going down also, and the equity funds are staying the same. So what people are doing is they're getting out of the bond funds and the money market funds, and they're putting their money into the equity market because they're getting price depreciation in the bond fund. Even though they're getting a level of interest, the price of those bonds are going down. They're not getting any good price appreciation yet in the money market funds because those levels are going higher, and they're waiting for better levels to start to invest in. Once we get that second rate hike coming in, and it's probably going to be 50 basis points, maybe we'll see some more money going into the money market funds. But great bottoms occur when there's a preponderance of people going into cash and not just moving their money out of bond funds where they're losing money into equity funds. So we want to identify conditions where the market sets a good bottom, thinking about just the ETFs and the mutual funds. Now, let's look at a sector, okay? So let's take the leisure sector, the travel and leisure sector. You know, what we saw in March of 2020 is No one flew, no one stayed in hotels, no one went on vacations. So we know that the hotels, the airlines, anybody that was a party to that leisure industry suffered substantially. Okay, and what we see, the top line right here is the number of people going through the TSA checkpoints, the travel security checkpoints at the airports. And the little squiggly line is the daily numbers, okay? And then the solid black line is the 7-day moving average of those. So we can see there is some volatility. And what we saw is a tremendous fall off. Now, we put that in line with also the number of people that checked into hospitals. And what we could see is on all of these times when the TSA line went down, the hospital admissions went up, okay? So the number of inpatient beds being occupied in hospitals were high at low levels of people running through the TSA checkpoints. Now what we saw in end of January of this year, we saw the Omicron bring down the number of people flying again as the number of people were getting admitted into the hospital. But in this case, our death rate, our mortality rate stayed very low. They just got sick. Probably some people wanted to be more careful than not. They got checked into the hospital, but they recovered pretty quickly and we're off and running again, and then we bounced back up. So now if we look, we're at levels that we were at pre-pandemic. Okay, so what we know about the travel industry, and we want to take this information, go forward, what we know is that people are traveling now. Okay, so if they're traveling, they're staying at hotels. If they're traveling, they're participating in the leisure industry, whether it's Disney World, whether it's going to the beach, anything like that. We know that our beaches, the college kids, overwhelmed the beaches in Florida, overwhelmed the beaches in Texas, because they hadn't been in 2 years on spring break. So this takes us through the end of November. We can see the erosion going on right here where the market's still doing okay coming into the end of the year. Then we saw a significant break, okay? But what we've seen right here is, see the rally that we had basically off of the January lows and then the March lows, and in late April or late March, early April, we retested those lows, took them out by a little bit, but we aren't anywhere near the highs that we saw here. So that travel and leisure space is not seeing any great participation within the market on a sector basis. So finally, what I want to think about is when we think about this whole market and looking at sectors and stocks themselves, let's just think about the forward PE ratio. So the forward PE ratio takes the price of the stock divided by the expected earnings 12 months out. So, because what we're looking forward. So what we've seen at great bottoms is some declines in that PE ratio, okay? The last number I have is April 8th, and as of April 8th, yes, we've gone down, but have we gone down deep enough yet to be able to identify stocks that are cheap on average? And the other thing we need to think about is that at very, very, very low rates of interest, okay, low borrowing costs, low funding rates, we should have a high PE ratio because there's no implied competition for returns. When bond yields are, say, 10%, okay, that's competition of returns for equity returns, because dividends returns won't be 10%. So for the stock market to outperform, it's going to have capital price appreciation. When yields are at 0.5%, there's no competition for stocks to outperform. The reason stocks did outperform was because there was so much liquidity in the markets. The Fed's now trying to take out that liquidity. So I would think we should start to see a decline in the forward PE ratio for the S&P 500.